Let's get to Jackson Hole this morning. Our Steve Leisman sitting down with Philly Fed President Harker. Hey, Steve.
Carl, good morning from Jackson Hole, where the Fed is this evening going to begin its annual summit. And I am here with Philly Fed President Patrick Harker. Patrick, we just reminded me this is our last Jackson Hole interview with you as president.
Yes, it is. Yes.
We've done this for something like almost a decade now.
Almost a decade, Steve.
Well, thanks for joining us this morning in the cold here. I want to start off knowing that Philly is known for its expertise in macro and micro when it comes to the employment and the jobs market. And Sarah was just talking about this. Do you see weakness in the job market or softening? How do you judge it?
So, do we see softening? Yeah, but we see softening from a very high level, right? We were doing a lot of catch up after the pandemic. It seems to me that we're heading back to what would be normal. Take the revision that we just looked at. That was not a surprise to us. We do early benchmark revision research at the Philly Fed, and we knew the number was going to come down. It went down a little more than we expected, but not by a lot. So things seem to be getting back into balance in a way that I think is good. Look, the number average, we were just talking about this, the average was still good.
174,000.
174,000.
242.
Go back to 2018, 2019. That was a really good number. So I don't think we're in a place right now, and you can't just look at that number. Look at claims today, look at other measures in terms of job transition rates and so forth that you look at. The labor market has definitely softened, but from a place where it was very difficult to get workers. I've been out and about in my district this summer,
right?
And what I'm hearing from contacts is it's easier to get workers, except for those things that they were having a hard time, those positions they were having a hard time with back in 2019. Nurses, machinists, you can go down the list.
Skilled workers.
Yeah, skilled workers.
So does it change your view on, assuming there's a risk management approach here where you're balancing the dual mandates, does it change your view at all of the risk that the job market may be weaker now and you have to guard more against potential weakness?
Yeah, I mean, it was all inflation for a while.
Right.
Now we're starting to see things, the balance of risk getting more equalized. So we do need to take more into account when it comes to the labor market, for sure.
What does that mean, taking more into account?
Well, I think it means this September we need to start a process of moving rates down.
And how aggressively do you feel you'd have to do that?
That's a really good question. So again, I've been
out, paid to do.
Yeah, I've been out talking to a lot of contacts this summer, and one thing I heard from them, bankers, business leaders, community leaders, is whatever you do, do it methodically and signal it well in advance. Give us time to absorb the change. I mean, they understood why we did what we did to bring rates up very quickly, but they're saying, please don't do that again to us. Now, barring something we don't anticipate in terms of the data, we need to start bringing them down methodically. What they say to me is, we don't really care that much whether it's 25 or 50. It's just start the process and keep it moving.
Do you care if it's 25 or 50?
No, in the sense I think what matters more is that we commit to start bringing rates down back to a neutral rate.
Okay, so this brings up at least two questions. The first one that gets me is this notion of the Fed being well positioned to respond to weakness. If you're too far from neutral, you're not all that well positioned, which argues for a more aggressive series of rate cuts to get to a point where you are indeed well positioned.
Yeah, I think we need to let the data speak to this. So right now, I'm not in the camp of 25 or 50. I need to see a couple more weeks of data. But I think it's, again, what people are asking for, and we're seeing this with the longer end of the curve right now. The markets are already responding. That's what matters. It's not the Fed funds rate that matters as much as the overall curve.